Are we witnessing the calm before the storm in the markets?
In today's episode, we have expert insights from Matthew and the team at Trade Brigade regarding CPI data and its market implications.
Plus, we'll explore the potential recession signals that could impact your strategy.
And keep an eye on James Rickards as he reveals the unseen threats from AI trading.
You're tuned into Financial Insights in Minutes, where we provide time-saving summaries of the day's top financial insights.
And don't miss our next segment on CPI reactions from Trade Brigade's Matthew, instantly breaking down the market's response to the latest report.
Today is CPI day. The markets are eagerly awaiting the latest inflation data.
Right, and we know expectations are leaning towards a hotter reading.
What's the core takeaway from the CPI report?
It indicates inflation is somewhat stable, but there's still volatility, especially in shelter costs.
Could this influence Federal Reserve decisions?
Absolutely. If inflation persists, the Fed might be cautious about rate cuts.
How did the core CPI perform today?
It was unchanged from previous expectations, which is a relief for many.
So the market isn't panicking?
Not at all. The reaction has been largely positive.
What trends are we seeing in the market post-CPI?
The market opened softly, but seems to be finding support around key levels.
Would trading strategies change based on these readings?
Absolutely. A cautious approach will be key for traders today.
What's the outlook for consumer spending during the holidays?
There's potential optimism, but it all hinges on inflation trends.
Will this affect retailers?
Definitely, they may need to adjust strategies accordingly.
What predictions are on the table following today's report?
We might see the Fed taking a more cautious stance regarding rate cuts.
How might traders react to that?
They will likely look for trends in consumer analytics moving forward.
What's the closing thought for investors today?
Patience is key. Let the market show its hand before acting.
Agreed. Focusing on key levels will be crucial.
Exactly, and stay alert for any major shifts.
Today, we delve into Peter Schiff's insights on the economy after Trump's win. What's happening behind those numbers?
Schiff argues that what we see as growth is actually inflation disguised as prosperity.
What does Schiff identify as the core issue with our economic portrayal?
He asserts that we're witnessing an inflation-laden recovery, not true growth.
What could be the implications of this misrepresented economic health?
Potential instability and risk for investors without significant adjustments.
How does inflation affect people's everyday lives?
It's eroding savings and living standards, making everything feel more expensive.
Could this lead to further economic issues?
Absolutely, it creates a cycle of debt and dependency.
What's Schiff's view on Trump's promises?
He believes Trump's policies will only exacerbate existing problems.
Is there any real hope for improvement?
Significant structural changes are needed, but they seem unlikely.
What does he predict for the markets moving forward?
Schiff foresees significant volatility and potential for failures in the banking sector.
Are investors prepared for this?
Many seem oblivious to the growing risks.
What are the implications of potential bank failures?
It could lead to a financial crisis, similar to 2008.
What should investors do in light of this?
They need to reassess their strategies and brace for volatility.
What's the final takeaway for investors?
Stay informed and ready to adapt to unpredictable shifts in the market.
Sounds like a cautionary tale.
Indeed, it's crucial to navigate these waters wisely.
Jeremy Shere raises critical points about the economy's trajectory, reminiscent of the 2001 recession.
He suggests the incoming administration faces immense challenges that might be underestimated.
What are the core points Jeremy emphasizes?
He compares today's cyclical issues to those of 2001, filled with economic pitfalls.
So he's suggesting we might be on a similar path.
Precisely highlighting that the challenges are profound and underestimated.
In what ways are the current indicators similar to 2001?
There's a clear pattern in bond market sell-offs and rising interest rates that mirrors 2001.
What about employment statistics?
They're lagging terribly, reflecting a severe cyclical downturn.
What structural challenges are at play here?
There are stark imbalances and persistent labor market weaknesses that are concerning.
How does income growth factor into this?
Stagnant, posing serious issues as prices continue to rise.
How does Jeremy view the potential economic outlook?
He warns of increasing volatility and a further downturn in employment.
And inflation concerns.
They are likely to rise, complicating recovery efforts.
What should viewers take away from this analysis?
Expect significant challenges ahead for the new administration.
Ultimately, is there a path forward?
It's going to take targeted strategies to navigate these rough waters.
Today, we're exploring James Rickards' warnings about AI's impact on financial markets.
He asserts that AI could pose serious risks to economic stability.
What are the main dangers Rickards identifies?
Increased volatility due to AI-driven trading decisions.
Could this change how we view market crashes?
Definitely, AI could accelerate and worsen the impact.
How does AI contribute to market risks?
AI mimics human behavior, but at an amplified scale.
What historical events can we relate this to?
Flash crashes show how fast markets can react.
What is the fallacy of composition in investing?
It's when individual good strategies become detrimental in bulk.
Can you provide a practical example?
Panic selling can create a market-wide crash.
Why is diversification critical in today's market?
It offers protection against AI-driven market outcomes.
What should investors focus on?
Include non-digital assets to diversify effectively.
What does Rickards foresee for markets influenced by AI?
A more complex interaction leading to potential rapid shifts.
How should investors prepare for these changes?
They should adapt their strategies to remain resilient.
What are the key takeaways from Rickards' insights?
Stay diversified and understand the risks posed by AI.
Would you recommend further education on these topics?
Absolutely. Continuous learning is vital in today's evolving financial landscape.
Today, we'll unpack Jim Rickards' insights on the current economic climate.
He anticipates a potential recession in the next 6 to 9 months, followed by substantial growth.
What's the core of Jim's prediction?
He suggests the road to recovery may be bumpy, but offers optimism for the future.
How does he navigate political implications?
By analyzing voter sentiment and its effects on economic policies.
Jim refers to how current policies hinder growth, right?
Exactly. Too much regulation can lead to slowdowns.
And what about the upcoming elections?
Elections will shape economic priorities significantly.
So what's the brighter side Jim sees?
He envisions a vibrant economy post-reforms akin to Reagan's era.
Do movements like these need time?
Definitely. Economies take time to adjust after shifts.
What concerns does Jim raise about AI?
He cites risks due to AI's lack of empathy in crises.
Should investors reconsider their approaches?
Yes, a mix of digital and tangible assets is prudent.
What does Jim predict for the economy down the line?
A potential recession soon, but robust growth after.
How does politics interplay with these predictions?
Political direction will heavily influence economic recovery efforts.
In summary, what's the key takeaway for viewers?
Adapt and embrace the shifts in the economic landscape, focusing on both digital and tangible assets.
An exciting era for investors ahead.
Absolutely. With the right strategies, the future holds great promise.
Judy Shelton dives into the need for a gold-backed dollar. Could this be a viable solution?
She argues that current Fed policies deteriorate buying power, posing a crisis.
What's Judy's main thesis here?
She believes a gold standard could reclaim the dollar's value.
And how could that combat inflation?
Gold backing could help stabilize purchasing power for citizens.
What does Judy say about inflation?
She articulates that inflation erodes purchasing power, reducing quality of life.
Is the Federal Reserve's 2% target beneficial?
Not really, as it consistently diminishes real wealth.
How does Judy view gold's role today?
Gold remains a safe asset, almost a necessity in economic turmoil.
Can the U.S. realistically reestablish a gold standard?
Yes, by valuing gold up, the dollar can regain its footing.
What are Treasury trust bonds?
They're bonds collateralized by gold, offering real stability.
How would these bonds function?
Investors can choose gold or dollar value at maturity.
What does Judy predict regarding gold-backed bonds?
She anticipates a growing trend towards gold-secured investments.
How would this benefit investors?
It solidifies trust and minimizes inflation risks.
So what's the key takeaway for financial strategies?
Pursue a thoughtful incorporation of gold in monetary policy.
Emphasizing authentic value makes sense?
Absolutely. It's a return to fundamental stability.
Well, that was a whirlwind of insights, wasn't it?
Absolutely. Each guest brought a unique perspective on the inflation data and its broader implications for our economy.
I found Judy Shelton's call for dollar reform particularly intriguing, especially her idea about going back to a gold-backed system.
Yes, and Jim Rickards echoed that sentiment, forecasting some recession risks but also holding on to optimism for future strength.
And let's not forget the caution advised by both Jeremy Shere and Peter Schiff about the looming dangers in our current economic landscape.
That's right. Plus, Matt's insights on trading strategies in this unpredictable environment really tie it all together.
If you enjoyed these valuable insights, don't forget to like and subscribe to catch more expert discussions like these.
Thanks so much for watching. Join us next time for more financial insights, and make sure to explore our other videos.